Hello, class. Welcome to Chapter 11, Conservative Mutual Funds. So, this chapter, we're going to focus specifically on mutual funds that are on the lower or lowest end from a risk perspective. We're going to title that Conservative Mutual Funds. So, again, a quick overview of mutual funds. Mutual funds in Canada come in various types and are not all conservative. This chapter, again, we will focus on the ones that specifically are conservative. Mutual funds like money market funds, short term bond funds, and mortgage funds. Bond funds are considered moderate risk, balanced funds, also moderate. Dividends are moving up to moderate, potentially conservative. Equity funds would be considered growth, and specialized or global funds would be a higher risk. So again, this chapter is going to focus on the lower risk, also sometimes described as being income focused. So firstly, the first type, we'll talk about money market funds. Money market funds, when I think about how they are used in my current practice and my role as a financial planner, is I would use money market as a cash position. It's basically the lowest of the low from a risk standpoint in regards to using mutual funds. Again, all funds are a pooled investment with multiple different investments all wrapped up within it. So, different holdings that are within a money market mutual fund could be treasury bills, bankers' acceptances, commercial paper, and potentially short term government bonds. If we think about the regulatory environment in regards to money market funds, National Instrument 81 102 requires that money market funds hold investments that have a maturity of less than or equal to 364 days. Typically, the average term to maturity being 90 days or less. And with money markets, unlike other mutual funds, the NAV per unit, meaning the price of a unit of the mutual fund of money market fund, stays constant at $10, whereas other types of mutual funds, as we'll cover a little bit later, fluctuates depending on the underlying price of the holdings. Not money market funds. They stay at a $10 unit and simply pay out the interest. So, what is the goal of a money market mutual fund? It is capital preservation, meaning keep its value, don't decline. Liquidity, meaning you can get access to it at any time. And stable but low returns. Again, all a very similar description to using some type of cash position within an overall portfolio. What are the risks of using money market funds? There is almost no default risk because there are only interest bearing investments that have such a short term time horizon. And there is virtually no default for risk, although when you're describing this to a client, you cannot say there is no risk, but is virtually no default risk. There is also minimal interest rate risk. We talked about earlier in the net economic chapter that investments with an interest rate attached to the investment, such as a bond, would have an inverse relationship to the direction of interest rates. So as interest rates rise, the value of an investment that has an associated interest attached would decline. It doesn't happen necessarily with money market funds. This has to do with that. We talked about duration. The longer duration for a fixed income investment, the more susceptible it is to movements when interest rates change. Money markets have such a low, a short duration that it isn't affected by interest rates. It's minimal interest rate risk. Returns are the return of money market funds is all treated as interest and fully taxable unless it's in some type of tax sheltered account. Money market funds don't create dividends, don't create capital gains, it's solely interest. And when it comes to returns for money market funds, you will see it quoted either as the current yield and effective yield. And we'll get into a little bit more of that a little bit later on. Oh, right now, actually. So again, current yield versus effective yield. So when money market funds are reporting yield or return, for a better word, it's either described as current yield or effective yield. And while other types of mutual funds report changes in the net asset value per unit, most money market funds, again, like I discussed in the last page, keep their NAV or their price per unit at $10 and simply report what the return is, what the yield is, what the yield is currently being earned at. So the current yield for the money market fund is calculated as the most recent 7-day yield on the fund, which is then adjusted to an annual rate. So in order to calculate this, we have 2 steps. The first step is to calculate the 7-day yield. The formula is on the screen. It's the ending net asset value divided by the initial net asset value minus 1. Once we have that, we move to step 2 to actually calculate the current yield, which would be 365 divided by 7 times the number we got in the first step, the 7-day yield. That will give you the rate of return / the current yield that a money market is returning. Mortgage mutual funds. So mortgage mutual funds, again, all mutual funds, a single product that has multiple investments within it pulled together. So inside of a mortgage mutual fund, you could find residential mortgages and commercial mortgages all pooled together. The goal of mortgage mutual funds is to provide income while preserving capital. The risks of investing in a mortgage mutual fund: there is some default risk. Default risk is the risk that the borrower does not pay back a loan or a mortgage. If you think about a residential mortgage, that is a mortgage on someone's house, like my own per se. The default risk is that the borrower that owns the house does not pay back the mortgage balance. There are ways to mitigate those risks. Some mortgage mutual funds would have residential mortgages that are actually insured by a third party, meaning that if there is a default that happens, the insurer steps in and pays back. So that would mitigate and lower the default risk. Another risk in investing in mortgage mutual funds would be interest rate risk. So the interest rate risk in a mortgage mutual fund is higher than in money market funds, but lower than other bond funds. So again, money market fund being the lowest of risk, mortgage funds would be one step up from money market, but lower in risk from a typical bond fund. The return of mortgage funds, you would be creating interest income, potentially some modest capital gains, maybe, not necessarily. So again, no dividends, but almost all interest, potentially some capital gains. And the expected return from a mortgage mutual fund should be slightly higher than a money market fund, but it's still a conservative investment. So again, we're going to touch on that whole concept of duration again for bonds and mortgages. So when we talk about duration, and we're talking about bonds or mortgages or bond funds and mortgage funds, the concept of duration, it's the measure of the bond's sensitivity to interest rates. So duration is what we mean. We mean by that is the length of the investment. So a 5-year bond that is being issued today has a 5-year duration. A 5-year bond that is sold 1 year ago has a 4-year duration. So as we mentioned a little slightly earlier, the longer a bond or mortgage or bond fund or mortgage fund, the longer duration of that investment, the more sensitive it is to changes in interest rates. It's always expressed in years, again, when we talk about duration. And again, higher duration, higher volatility, and more sensitivity when interest rates change. The concept of duration is used by fund managers to position the portfolio, and used by someone like ourselves and yourself, if you get licensed, to compare funds to each other. You might compare two bond funds and look at the average duration that's held within these funds. One with a shorter duration or average shorter duration within that portfolio is going to have less volatility and less fluctuation if interest rates change. Short-term bond funds. So if you're looking at a bond fund, it would either be called simply a bond fund or a short-term bond fund. And all that has to do with the difference between those two is simply the duration. A short-term bond fund has a shorter duration of all the maturities in there. Typically, short-term bond funds they're a longer duration than money market funds, but typically on the higher end of that. So most money market funds would have that less than 90-day average duration. Typically in a short-term bond fund, you're going to have anywhere between that 90-day to a year average duration of bonds within it. The objective of a short-term bond fund, again, capital preservation and income. So again, from the risk perspective, it's got more risk than a money market fund, but less risk than a long-term bond fund. And because of that, the return should be slightly greater than a money market fund, but slightly less than a long-term bond fund. Again, more risk, more return, typically. So again, typical bond fund. A typical bond fund is going to hold the option of either government or corporate bonds. The duration compared to both money market and short-term bonds is going to be longer. Typically, bond fund will hold bonds that have a duration of greater than a year. The objectives of a bond fund is to generate income, preserve capital, and again have some potential for capital gains. But the majority of the return from a bond fund is expected to come in the form of interest. The risks of holding a bond fund, again, interest rate risk. The interest rate risk for a typical bond fund would be higher than money market and higher than mortgage funds and higher than a short-term bond fund. As well, default risk becomes an issue. Typically, bonds with less than a year, especially less than 90 days duration, the risk of default becomes very small. The longer a bond fund goes for, the longer duration is, the more chance of that government or corporation defaulting on the bond and not paying it back. Dividend funds. So, like the name says, a dividend fund holds or pools dividend producing stocks or shares. So the holdings might be preferred shares, they might be common shares with a strong dividend history, or a combination of both, or only one or the other. The objective of a dividend fund is to earn dividend income, try to preserve capital, but there also will be some capital gains typically in a dividend fund because dividend funds, again, own predominantly stock or shares. There's always potential for capital gains or losses for that matter. But the primary objective is not to focus on the gain or the rise of the share price, but simply focus on the income that is being produced by these shares. What are the risks to dividend funds? Again, we've got a default risk. We talked in an earlier chapter the difference between preferred and common shares. Because preferred shares are a bit of a hybrid in between what a bond is and what a share is, there is some default risk that a company would not pay back a preferred share. So always a bit of a risk for dividend funds. There's market risk. Again, the share price can go up or down. And there is interest rate risk. Interest rates tend to have an effect on the amount of dividends being paid out by a company. It's always a risk. Dividends are taxed more favorably due to the dividend tax credit, which we discussed earlier. So, although I wouldn't call it a risk, I would call it a benefit. And again, so we talked a little bit about how dividend fund could hold preferred shares or common shares. Typically, they're going to be separate. You would have a preferred dividend fund or just standard a dividend fund. The preferred dividend fund would hold mostly preferred shares, where a regular dividend fund would hold mostly standard common shares that pay dividends. Now, if you think about volatility, risk versus return, I mentioned it before. The more risk that is taken in an investment, the greater opportunity or potential for return. That doesn't always play out, doesn't always equal, but it is a concept we need to know. We need, as part of the exam, you need to understand the hierarchy of these different funds. So from lowest risk up to highest risk. So if you think of the lowest risk mutual fund, we've been talking about money market funds. The next going up would be a mortgage fund. The next would be a bond fund. You could slip short-term bonds in there slightly underneath a standard bond fund, but at least know that in order from lowest risk to getting up towards higher, we would start at money market, move up to mortgage, then to bond. Above that would be a balanced fund. Above that, a dividend fund. Above that, an equity fund. And the highest risk, specialty or global funds. And we're going to go into a few of those concepts a little bit more, but at least for the exam, understand lowest risk to highest risk from those different types of funds. And again, MMFs, when you see it on my screen, it means money market funds. They equal the lowest risk, but also the lowest return. Bond funds equal a moderate risk with stable income. Equity and special equity funds means a higher volatility, but a higher potential for growth. So again, the key takeaways from this chapter: know the structure and the goals of money market, mortgage, short-term bond, and dividend funds. Understand how duration relates to the volatility and risk of an investment. Differentiate risk levels, be able to rank them, money market, mortgage, and bond funds. Be able to calculate that current yield, look back at that calculation, that formula that I stated earlier, and know the tax implications. Which type of mutual fund we've discussed creates interest income, which creates dividend income, which potentially creates capital gains. That's it for now. If there are any videos that I have that will assist with this chapter, I'll post it in the chapter folder. Bye for now.